Now, I would like to welcome to the panel, from right to left. I'm not going to introduce the speakers again, but the panelists. We have Mark Sadler, dear friend, who is the practice manager. I never quite know what that is, but you'll... Okay, good. The practice manager, climate funds management at the World Bank. Yunus Arikan, also a good old friend, who is head of global policy and advocacy, global services at ICLE. No need for any introduction. Oh yes, I have, it's getting a bit embarrassing here. Sort of Liane Shalatek, who is the Associate Director of the Heinrich Böll Foundation North America. And also, are you still the active, yes, active observer, civil society at the Green Climate Fund? Danke. Mirza Shaukat Ali, Adaptation Fund board member from Bangladesh, and obviously in the least developed countries group. We have Eric Theroux, who is the Deputy Assistant Minister Fight Against Climate Change of Quebec. And we've seen you. Yes. Achala couldn't make it again because she had to go back for the negotiations. But what I suggest that we have heard from the speakers, and I would like the panelists to give a short sort of well, whatever you want to say from what you've heard and what you want to support, what you want to question, and then we have Q&A with the audience. So please, would you want to just...
Thanks, Benito. Thanks for the invitation. I would start by saying that, like Kelly, I'm not, sorry, one of the specialists on the stage in this issue. But I'm just here to, as Benito mentioned, as a representative of the government of Quebec, who was the first subnational government to develop a measure by which, being a subnational government, we invested in international cooperation program for more affected countries in la francophonie, so francophone members. We established a program by which we do some form of cooperation, and this international cooperation started with a contributions to the least developed countries fund of $6 million besides the COP21, and it was managed by GEF, the Global Environment Facility. And we started the practice that we were quite grateful to notice that other subnationals follow, like the Wallonie and also others. So to us, it was also a counterpart to the fact that being subnationals and being in charge of so many measures in relations to climate change, we have to recognize the specific role of subnationals in the fight against climate change on both pillars, mitigation and adaptation. But being recognized into the Paris Agreement is one thing, but we should contribute on the other side. So it's the other side of the coin. Being recognized is fine, but we have to contribute. So we proposed a measure by which we gave contributions to GEF, and we developed as well an international cooperation program by which we combine the on specific projects done in the francophone countries that makes an organization, either a research network or a company or an NGO, with a counterpart in the South, and they do specific project dealing with either mitigation or adaptation. And what we, it was not Sean was speaking of big amounts of money. Our contribution was really small. It was 25.5 Canadian dollars. So, but for us, it was quite something nevertheless. And all the projects that are already processing, we basically, we have spent all $25 million, and we just changed the government in Quebec at the beginning of October, and we are in the process to recommend to the new government to pursue the engagement in regard to this program, having in mind that it is really important to have part of that is a contributions to multilateral funds. Why? Because it's the best way to make sure for us that it is managed in view or with the aim of a real contribution settled in time, and that could be renewed easily. So we will work also with our partner in the Western Climate Initiative. So now we have a joint carbon market with California, and we engage in the conversation with our partner in California in order to see how we could manage to get a commitment by all jurisdictions or even future jurisdictions that will join the Western Climate Initiative in terms of commitment to multilateral engagement in cooperation. So I would say that for the moment.
Thank you. Thank you, Dr. Benito and ECBI, Oxford Climate Policy, for inviting me to share some of the thoughts. First, let me share some of the initiatives that my government has taken, especially in terms of mitigation. We are working on some NAMA projects. We have taken initiative for 2 NAMA projects in railway sector, and we are going to submit those 2 NAMAs, and expecting in the future we are going to access funds from GCF. Coming back to another initiative which is similar to that of CDM, is we call it joint crediting mechanism. We are doing this with Japan. We have initiated 3 projects at the moment, 4 projects, and the next project is 50 megawatt solar power project, which has been approved, and hopefully in the near future we are going to implement that project. So these are some of the initiatives, and apart from that we have taken some energy efficiency initiatives which also contributing to emission reduction, like some solar initiatives, solar irrigation, solar home system, and other small projects which is contributing or saving 8.92% of the total energy requirement in terms of tons of oil equivalent of our total energy demand. At the moment we are generating 19,000 megawatt of electricity, out of which we are having 3% renewable, but we have a target of achieving by 2020 10%, and there are few projects which are coming up soon. Time is short, but we are coming up with 2-3 big projects, so hopefully that will be able to reach our targets. Having said that, in recent years, in recent months, Korean government has come up with some climate change initiatives, especially mitigation projects. They have their own emission trading system. So they have already registered last month 1 CDM project, and 2 projects will be hopefully initiated within a couple of months. And why I'm telling this, I hopefully maybe some sort of CERs will be generated from those initiatives. I don't know how much that will contribute, but the prices of CERs, I mean, they are buying per ton of CER is $4.5. We have just concluded for 2 million improved cooker stoves, and hopefully in the near future we are going to also sign contract for 4 million improved cooker stoves. Coming back to this discussion, as I am one of the member of Adaptation Fund Board, Adaptation Fund is very dear to me, and I also, as a LDC country, I also consider that LDC Fund is also very dear to all the member states, because it's a dedicated fund for the LDCs. But unfortunately, the fund disbursed to these two funds is not significant. So what Dr. Benito over the years is trying to do, if it sees the light, so it will certainly contribute to a great extent to, enhancing the portfolio of these funds. But some of the inherent problems which we can observe from a national government perspective, at the same time, as a member of the board, like Adaptation Fund Board need to enhance their profile much higher. I mean, $100 million is not much. Per year they are at the moment collecting. I think if they really want to have significant contribution at the local level, at the community level, then we need to improve the amount to a larger extent, like say $300, $400, or $500 million, because although in your report, in your document, I have seen that like they have already reached 3.6 million population. But what I can say, like in terms of this is related to project beneficiary. But in real sense, how many people has come up, have built a resilience? So that is one of the significant question. I mean, how much these funds has really significantly improved the quality of life of those people to at a level that they can sustain climate impacts. So those are the issues that need to be seen by both Adaptation Fund as members at the national level and as a party. And coming back to some of the presentation, I consider that the idea that was presented by Anne, I think it's a very challenging one, because if you take into consideration that we have started this idea of $10 billion and then $100 billion from the Copenhagen Climate Change Summit, and unfortunately we are yet to reach 100 billion mark, and it will be really difficult. By 2020 we're going to have that amount of resources, and generating 300 million on loss and damage, which is not yet accepted as a permanent agenda item in SBI or other issues. So I think we need to be more realistic so that we can have mobilize those kind of resources, especially compared to this one. I prefer these IAPL ideas because it is going to impact some of the comparatively richer people. But compared to that, your idea is like when the prices will increase, when the taxation will be imposed, certainly the prices of oil will increase, and then it will impact the mobility, the products. So ultimately it will impact the whole gamut of population. So I consider that you need to look into these ideas from a very pragmatic concept, and hopefully, but I like the concept. I think with other suggestion, you will try to improve this idea. Thank you very much.
Yes, thank you very much for the opportunity to be here. And I'm here despite the fact that I clearly and transparently disclosed to Benito when he issued the invitation that I'm not an expert on those issues. However, I did, and again from the experience in working on the Green Climate Fund and around the Green Climate Fund, traveled a little bit back down memory lane and to the beginnings of the discussions of around the Green Climate Fund, including in the Transitional Committee 2010, when we were discussing and developing the governing instrument and looking about sources of financial input in the Green Climate Fund beyond grants and loans from developed country as the main source. And in the governing instrument, in paragraph 30, there was the reference to alternative sources. So alternative sources and innovative sources, at least at that time, it sounds like I'm talking like a generation ago, at least at that time, we're seeing very much similar or being pretty much the same. And I think the discussion at that time, again, 2010, was very much informed from the experience of the financial crisis of the time, when we actually had experienced how possible it is in the face of a global crisis to mobilize massive amounts of money in a very short time. And what comes to mind there is the G7 summit that we had in London. I think it must have been in 2009 or 2010. In any case, at that time, we generated, I think, 800 billion or more, basically with the stroke of a pen, by the issuance or by release of special drawing rights. And so at the time when we were talking about possible innovative financing sources for the Green Climate Funds, it was things like special drawing rights or the currency or financial transaction tax that very much came into our mind. And unfortunately, while obviously there is a small subgroup of European countries within the European Union that is still trying to basically expand a regional financial transaction scheme, it hasn't caught on. All of those schemes actually could and would generate significant amount of monies, and the nice part is they are technically feasible. They are as feasible as a lot of other approaches, and there is that famous paper from the IMF at the time that was actually looking at possibly using SDRs for special drawing rights for the climate purpose, and it was politically buried. It wasn't buried because it was a crazy idea or because nobody should further think about it, but because developed countries, who are the ones of whose resources special drawing rights would be drawing from, didn't think that money should be used in that way and wanted it to be basically kept to make sure that we have that as a little safety net for continued fluctuations on the financial market. So again, I think it's important to go not just what seems innovative in the sense of what is the political flavor du jour, but also what is technical feasible, and maybe look back at some of those older proposals. And that comes to mind particularly, and the GCF is, had just kickstarted its replenishment. So we are gonna discuss about what sources of financing we should be drawing on, again, in addition to hopefully the very significant public contributions from developed countries that we are all hoping to get. So it's in that spirit that I think we should go back to some of the discourses about larger scale publicly funded, public common good funded contributions, and not allow alternative sources or innovative sources to be diverted into directions that I personally think, and actually a large part of the CSO community that I represent in the Green Climate Fund, that are completely inadequate, such as a focus on family office, philanthropic funders, or high net worth individuals. And I personally shudder when I look at papers like one that we had proposed for the 20th GCF board meeting, was not discussed, but it's bound for discussion, when you're actually thinking about how you could get that philanthropic money or high net worth individual money, or you know, money from really rich people like Bill Gates or the Bezos of the world into the Green Climate Fund. And then there are things that pop up, like maybe we should think about GCF logos, or maybe we should think about trying to give preferential access to governance structures and so on and so forth. So I personally shudder. I don't think this is the way that innovative financing sources or alternate financing sources should be defined. And again, maybe it's time to actually equate the global climate crisis to the existential financial crisis, the same existential crisis that many felt the financial crisis of 2009, 2008, 2009 presented, and look at the recycle or look anew into some of those ideas from past times. Thank you.
Thank you. Good evening, everyone. Thanks a lot once again, Benito, for this opportunity to this important discussion. And I was not in the beginning of your seminar, but I know your preparatory remarks where you were recognizing our effort as trailblazer of this effort. So ICLE, Local Governments for Sustainability, is one of the oldest global networks of local governments at all sizes and all levels and all countries. If you look at any successful climate action, I think they're somehow our members, so that's what we are happy. But what we would like to share here is in Montreal in this year we have revised our climate strategy. We have now, just as Quebec colleague has mentioned, when we say that in the Paris Agreement local and regional governments are recognized for the first time, this is changing the way we communicate our members. Before, we were encouraging for voluntary action, or we were encouraging them, this is something good. But when we are saying that we're engaged as an important partner in the Paris Agreement, we have now more responsibility. And then we connected this climate neutrality target of the Paris Agreement, and we agreed, or as collectively, that we encourage our members to go to climate neutrality before mid-century, and it should not be anymore a voluntary initiative, but it should be every council has to adopt it regardless of their size. And then, of course, question comes, what do you mean by climate neutrality? And all these 20 years of experience we have compiled in a logic that, okay, first, go for ambitious 100% renewables or low emissions as much as possible. Second, divest your efforts. Third, invest in your city, into these kind of revenues that you generate, additional money to sustainable management of urban resources. And the fourth, we started to say that offset, in the sense that it could either be supporting or purchasing accredited mechanisms credits in terms of the ones that will be recognized by UN now and later, or the money that you would like to offset in equal amount, invest in global funds, so that this money can then be pooled and then reach to the countries in the cities in the developing countries. And that, what I'm saying is 25 years is all these experiences we had seen. I'd like to raise the issue that for so long we were saying that yes, CDM is not working for us. It takes so long time, it is so complex. 10% was total amount of CDM that was flowing to the local government budget. So we said that, okay, direct access. Direct access was a dream. It still is a dream, and it will never be a reality, I guess, because it's still a national government's process. But we should also try to say, okay, what is the new tendency? Then we have heard about members like Brussels Capital Region. It was before Paris Agreement. It was the first pioneer, starting with 500,000 to GCF. Then it was followed by Wallons and Flemish. Then City of Paris followed. Quebec came with the biggest money. First, we were afraid because we as networks of local governments, we were asking for our members to pay us so that we can help them. But sometimes these kind of constituencies, it's very hard for them to pay for $2,000, but they can easily pay $2 million to something else, as long as they see that there is a recognition, which is the UN and affiliation. That's right, that's okay. So we first thought about it as a threat. But then we said that, okay, let's turn it into an opportunity. And then the next experience came, which is the New York City, that announced divestment, which was not the first city to divest. In fact, it is one of the last cities to divest. Before, we were around 100. And it started with our very poor municipal Dunedin from New Zealand that first announced divestment of their municipal budget. But New York City's scale of the budget they have generated was impressive. And we started to question, okay, where this money will go? Where will this divested fund will go to? And that's what we started to discuss. We've prepared a case study for New York City as well, how they have managed this divestment. And now, just before we adopted our goals or our strategy, New York City made one more effort, saying that the money I invested, channeled, will go to $2 billion to the citizens of New York, and we could start to think that, okay, some of them maybe could go back to the international processes. And we were saying that, okay, we are having difficulties from receiving monies, at least when we say we, the members in the South, because the money is coming from the national processes. If the money comes from our brothers and sisters, and if it is so hard for us to manage this fund on our own, and if we go to the funds saying that, look, we generate new money for you, just make sure that this money is multiplied by 10 and come back to us, to other members in the South. This changes the dialogue, because it can come up with a huge amount of money. If in the near future we can make it possible, then we are the one who decides to shape the flow of this money. So therefore, we're eager to have this discussion. We also have started to contribute to Adaptation Fund through our Congress participants' voluntary donations. Over these couple of months, I think what we would like to see in the future is that, yes, if we're living in an urban world, if the local and subnational or regional governments or subnational governments at all have their municipal budgets as a public money that can be part of the global process, let's encourage them. First, let's honor their contributions. We should increase the number of regional governments like Quebec, but it is not increasing easily, so maybe we should try to create some incentives, some recognition for that. And we should also start to design the mechanism, because channeling the municipal budget to an international process is even harder than a national process. So we believe there is a way we can go forward, and I would be very happy out of this discussion in the Paris Committee on Capacity Building. We are at ICLE are also working for other areas. So let's hear what you can give us as recommendations. And our goal is that by the time we reach to 2021, we would like to increase the number of those pioneering cities, their international frameworks defined, so that this increased money can come back to us. I'd like to conclude by two questions to our panelists before, if maybe in the round they can answer. In the climate summit in California, we have made an agreement with climate bonds, Sean, that ICLE will also contribute to the existing initiatives. That is exactly related to this question that I would like to address, because yesterday we had a session with the banks in the thematic human settlements thematic group on Marrakesh Partnership. The outcome was that let's not always list our good practices, let's give some bad practices, why it failed. What I would like to encourage is that I'm coming from Ankara. Ankara was the first metropolitan government who issued a bond in 1989. It was the source of the railway, wastewater treatment, and even solar power panel of Ankara Metropolitan Municipality in 1990. But it failed so badly that no other city started, because it was funded through bonds. So I know the history behind that, but I would be much more happy if climate bonds can help us to make more objective assessment, so that, because this leads to the question of Axel. Looking at your charts, we still see developing country cities are not able to issue bonds. One of the reasons is that the developing countries are fearing the moment they open this box, the existing debt to the national budgets would scale up, because they will not be able to control. And actually, the case of Ankara has some lessons learned. So let's try to address what failures have resulted in the past, so that we don't replicate these mistakes so that we can leapfrog, and then we can be able to convince much easily our partners in developing countries. The second point would be to Julian, the connection to divest, invest discussions. How are you working on that? Because they're talking about $10 billion, trillions, whatever the money. The difficulty what I'm having with the taxation of fossil fuels is that this gives us the logic that if we want to have money, we should still consume the fossil fuels. But we are saying that keep them in the ground. So if we create a model for fossil fuel taxation, we would hope that they will continue to be generated, dragged, and that it will be much worse. So that's why we're not too much inclined in this kind of levies. But let's see. But I think it would be much better for this community to connect to the divest movement, divest investment, because the volume is increasing. Now 150 governments have announced their divestment portfolios, and we want to increase this. That could be a much bigger source of income as an innovative finance from different levels of government.
Not saying the best till last. More comments on what I heard today. I think one of the things you've managed to really highlight is that it's an elephant problem, right? So it's lots of blind people grabbing different parts of an elephant. And one person grabs a tusk and says, oh, it's a spear, and so on, the story goes. And that really is what finance is, right? So people use the word finance to cover whatever particular thing they're talking about, and these things don't really match up, and the conversations don't either. I recently went to the OECD Green Infrastructure Conference in Paris, and I was really shocked there with the conversations that were suggesting that pension funds should build bridges. But of course, you talk to the manager of a pension fund, and they're legally required to maximize returns and minimize risk for pensioners. But all the while, no one's actually built that bridge, and it's been commissioned, and it hasn't fallen down. That's a relatively high-risk thing. So there's an intermediate stage where someone needs to finance it, turn it into a financial asset that is then suitable for institutional investors. And yet still we say, well, pension funds should finance climate change adaptation. And that's not the business they're in. We need to create financial assets that they can finance. So there's you said, I deliberately didn't have any notes to sit down and then talk about. And I sat down and I wrote down 50 things, because that's pretty much what this subject ends up looking like. So the takeaways I think that are important is, with finance, is what are you looking to actually finance? And what types of finance really fit with it? So innovation, which is what we will need to get to the 1.5, 2 degrees, doesn't really work terribly well with institutional investors and bond markets. If we're going to put the moonshot out there, which basically means we need to fund 100 things, and we're lucky if we're going to get 2 to actually work, you need to go and find the right type of money that's really going to want to fund that. Sean was touching on the point about issuing a bond with an underlying asset, which is therefore reducing risk, whereas at the bank we're issuing bonds for pipelines that we will then go and do. It's just the market understands that that's our business, that's what we're going to do, that's what we can deliver. But if a bank suddenly walks into the market and issues it as a commercial bank, because of the structures, they're not quite so sure, so it's better to package up underlying assets. The trouble that we have is we need to generate vast sums of capital right now to deliver those projects. They're not there now. And so this is one of the interesting things about the 90 trillion versus the 50 trillion of existing stock of capital in infrastructure. When you actually start looking at the required leverage, the money that has to come now, where are you actually going to really generate that from, given that these assets don't actually exist? And another thing that I think often comes up and becomes part, or needs to become part of that conversation, is we tend to focus, in climate we focus a lot on sources of money. We're really heavily focused on where's the source of that money. And generally those conversations are about billions. And yet the uses to get to the just transition and low carbon resilient development are in the trillions. and we spend an enormous amount of time on the billions, and that's putting aside climate justice versus climate finance. The trillions that are required, we can continue to spend an enormous amount of time talking about climate finance and the billions, and we're never going to get there. That's putting aside climate justice as a separate issue. Now, there is an interconnection, but there are separate issues. And then, so on the uses, I think it really comes down to us also making some really hard choices now about, once we have the cash, where do we actually really spend it? Because where are we really going to use our concessionality? Are we really going to use it around markets where we think that pretty much the private sector can deal with this? And we need to use a very, very small amount of concessionality? Or do we really need to use it in areas where private capital won't go? Smallholder farming in Africa, for example. Infrastructure in the deltas in Bangladesh. In places when we really look at what the underlying capital structure looks like going out, a lot of the stuff that we need to finance is the stuff that is going to be incredibly high risk under 30, 40 year. But in a transition, we can't just not do that. So when you look at assets under real threat and you look at, okay, what does sea level rise really look like and where are vulnerable populations, that's where we're going to have to be spending large amounts of capital. And arguably, and that's what we would argue, of course, that's where the concessionality needs to go. That's where I think it links back into the climate justice discussion. That's where this money really needs to be going. And so I think it's the trouble that we've seen and we continue to see is these hard decisions around the concessionality and where we're really going to put that cash to have the biggest impact. Remembering that the impact is not just about mitigation, it's mitigation and adaptation. It's carbon plus. And that, I think, is one of the biggest changes we're seeing in the carbon finance world, is an increasing wish, both from the buyers to not just be buying a carbon asset, but a carbon plus asset. What are the other social outcomes that attach to that underlying asset, and ensuring that you're doing it in an environmentally sustainable way? And that's a huge pivot that we're seeing when I'm thinking on the carbon finance side of our business, when we're talking with both sovereigns and the private sector. And that's a really important change. And quite often when we're talking about this, we're also not talking about the results-based finance and how that can leverage money.
Sorry, I have a minister to brief, so I have to leave.
Thank you. So we have time for 3 questions from the audience. Where is? Yeah.
I'll try to make a brief question. I am not an economist, so I am learning through all these experiences and your lessons giving. I'm a bit confused because on one hand I hear about solutions in bonds and taxing, but then on the other hand I hear the warnings on this taxing on fossil fuels. Nonetheless, in the meantime, I think it's a solution in the middle road, but then in the future road, maybe not so much. So I would encourage you to give us some clarification for the immediate actions. And then, of course, climate justice is another big issue, and then people and society that will be damaged because of the water rising and the temperatures that will start doing migration, and then where is the money going to come from, where are they going to go, and who is going to execute this money. So there's a lot of, from my point of view, there's more questions than answers, but I thank you all because it's been a wonderful panel. Thank you.
Okay, Paul? No, Paul first.
Thank you very much. I think that the window of opportunity for climate finance that opened up in 2009 started to close in 2016. And the consequences of that, I think, have not been totally assimilated. The Fed rate, as we all know, was 0.25 from 2009 to 2016. It's now 2.25, and the tendency is towards a continued increase. In this period, commercial bank representatives have scoured through the developing countries looking for business, and they found it. So a lot of countries with the low interest rates have become heavily indebted. This scenario it gets a sensation of deja vu, because in 1981, when the first tequilazo broke, Alan Greenspan and the New York Federal Reserve Bank crowd got together and decided that this was not going to be a U.S. bank crisis, but a Latin American debt crisis. And the interest rates went sky high. The LIBOR in 3 years went from 3% to 18%. And Latin America was pushed to the wall in what is known there as the lost generation. No, the lost decade, rather. The lost decade of Latin America and the Caribbean, which is quite obviously the last thing we need now when we have climate finance plus the Sustainable Development Goals in play. So that's one point. A second point is the lack of evaluation in economic analysis at this point of time of how prejudicial high rates of inequality are. That's not to say that no one talks about it, because both President Kim of the World Bank and Madame Lagarde of the International Monetary Fund have said that the extent of which we're in inequality now is prejudicial for the world economy. What has been done about it? I would suggest that after the 2009 crisis, nothing. And we have examples from the past when there was a high valuation of the nocive effect of inequality. After the 1893 long depression, what did you get? The Sherman Antitrust Act. That was heavy stuff. It was Rockefeller and oil, it was Carnegie and steel, it was Harriman and railways. They took on the largest economic interests in the United States, and the Antitrust Act was enforced. After the 1907 financial crisis, when J.P. Morgan bailed out some of the New York banks out of his pocket, and then later thought that that sucked and he never wanted to do that again. So he took some of his friends to Jekyll Island off the coast of Georgia, and they mapped out what eventually would become the Federal Reserve Bank. But that wasn't the really important thing that happened then. It was the progressive income tax. That is big time redistribution. And after the 1932 crisis, you get Social Security, real redistribution. And most of these things were copied in other countries of the world or spread out to other countries of the world also. After the 2008-2009 crisis and the Great Recession that followed, what do we have? We have reforms that have to do with systemic risk, but not redistributive reforms to address the high level of inequality. And that will affect also the Sustainable Development Goals, and will affect the climate finance as well. So I would like to posit those two queries for the panel.
Yes, thank you. Yeah, a bit on the same lines. On the one side, we see an increasing unwillingness of populations in various places of the world to be subject to carbon pricing, carbon taxation, alternative forms of finance, or however you like it. On the other side, you see an unwillingness to use markets to mobilize the mitigation. You mentioned, well, there might be some appetite for, let's say, packages of mitigation linked to sustainable development goals, but still I'm missing the real willingness to pay for those packages. Yeah, in my view, the elephant in the room is this. Well, we are squeezed between these movements. Does anyone on the panel see an opportunity to nurture an approach that actually can mobilize new finance without hurting itself on the populist movements in the countries that are now emerging, and on the other side, the lack of willingness to let markets play?
Thank you very much. So we have hopefully 3 short answers, if at that, because we then have to close the meeting in order not to miss the reception, which we really don't want to miss. So can we have any volunteers to say something about... Okay, I thought so.
Was that a surprise? Well, not a surprise for you, damn. Case studies in failure, Ankara, Malaysia. There are lots of case studies in failure of bond issuance around the world. There's usually a governance issue. Mozambique's a real case study in failure. Although I will say Mozambique is paying off its debt at 14% after having indulged in some nefarious practices around the time of its tuna green bond. So interesting point, interesting question. We have failures. You know, we've had a lot of failures in the US and Western Europe as well over the years. Markets generally absorb them and move on. So there's not going to be an absence of failures. It's going to be a problem for a country like Turkey if its ability to raise funds across the country is affected by one failure. I absolutely agree. You know, in Malaysia, we've had a failure of the covered bond and ABS market because the Malaysian government allowed, essentially, a couple of crony funds to scam the market. Lost confidence, set back 15 years. So it happens. I'm not sure there's a silver bullet solution, but it would be interesting to work with you on that question and tackle it. Of course, it's related to country debt loads to a certain degree because the ability of the country to be able to borrow to bail out these situations makes an impact. My own view is the transition requires substantial amounts of guarantee to move forward. You know, with the IFC, when it helped Johannesburg bring its first bond to market, gave a 45% guarantee. That allowed Johannesburg to get a higher credit rating than South Africa and got a very low interest rate as a result. Now, of course, they paid the IFC a fee for the privilege to make it work, but nevertheless, it got them into the market. When it had the green bond, later on, they didn't need any guarantee. So, you know, the first bonds are always challenging and you need some support. 1. 2, local capital. In Nigeria, we're working with the government on green bonds, Paul. We're not going for international capital. There's adequate local capital pools, but they still need credit support. Rich countries can provide the credit enhancement for local investors to benefit because they're not under the current fiduciary rules there. Now, I don't know about Nicaragua capital pools, but I can tell you India has more than enough capital to fund its entire transition. It's just in the wrong places now. It's in gold, around people's necks, or in property. But even then, with some credit support by Germany or Sweden or whatever, we could have much more issuance to the Indian market that would meet the regulated appetites of insurance funds and allow capital to move domestically without international. I happen to think international's got a job to do to support the transition, but that's how you deal with the problem you're raising from my perspective. Lastly, the generation of vast sums of capital, going on from that point, I'm a bit more optimistic about the amount of capital we have on the planet. We have tremendous inflows into pension funds and insurance funds every year, net inflows. We have managed in some countries to develop good models to pool savings. Those savings are remarkably underutilised. In Zambia, for example, the National Pension Fund is only allowed to invest in AAA government bonds. It wouldn't take a lot to allow some AA, Zambian AA equivalent if you like, to expand the pool, especially if World Bank supported them with some credit support to make sure they met their... So, you see how the transition works? The capital's there, actually. The savings pools around the world are absolutely there. One thing you can say for absolute certain now, we have money pouring out of our ears around the world. It's just, of course, as ever, in the wrong place. This is how we push it to the right place.
Thank you. So then, Julie, and the final word is Mark. Okay, very quick.
Final word, yeah. I will try and be super quick, which means I might not explain things in full, but I will be brief. I think I don't think we will fix the climate crisis without fixing the inequality crisis. And to do that, we need to claw back the power that we've given to the fossil fuel industry and to their governments that are boosting them. And that's the climate damages tax will help to do that, to point out that, you know, at the moment, fossil fuel companies are making billions of dollars and they're doing it off our backs. We need to address that. And I was asked two related questions. I didn't really, one maybe, yeah. Anyway, I was asked two related questions. Janos asked about the divest-invest connection, and then the question was about, well, we need to phase out fossil fuels. What do we do when that runs out? So the answer is, we absolutely need to phase out fossil fuels by the middle of the century at the latest. That's got to be the primary objective. There's no fallback position from that. Fossil fuels have to be phased out. The climate damages tax is complementary to such an approach, because not only does it raise funds for both loss and damage and for fair transition, so it helps communities and countries to transition away from fossil fuels. It would also apply a price on carbon. It would be a global price on carbon if you implement it the way we recommend. And that would help the transition to renewables. So it would help, but it needs to be embedded within a phase out. So hopefully very soon, the money would run out. And that's why our proposal is for this escalating price, $5 a tonne of CO2e, plus 5, plus 5, plus 5, plus 10, plus 10, plus 10, which would very soon get you a price of $250 a tonne of CO2e, which is not a small price of carbon. But nonetheless, we have incorporated this element of ensuring that low-income people have the fair transition funds to help them to transition. So the two are it's complementary to a phase-out, and a phase-out is the most important thing that we face. And absolutely, in the long term, we are going to need other sources for loss and damage and for other climate finance. And so we need to look at a basket of things, including EAPL, including financial transaction taxes, including everything we can think of. I mean, the climate challenge is the biggest challenge we face, and it means we have to fundamentally reassess how we do things. We can't just fiddle around the edges anymore. We've spent 20 plus years fiddling around the edges, and it has got us nowhere. We need to really fundamentally reassess the way we do things, and that's where we hope the climate damages tax adds to that conversation.
Yeah, just really quickly, I'm struck by a couple of things that were coming up in the questions, including Paul indicating that we are at a time where we need to tackle both climate finance and the SDGs and the climate crisis. We also see an increase in indebtedness of countries, heavily indebted poor countries, and probably a repeat of some of the debt crisis that we were facing years ago. And obviously, in a country that is written by debt crisis, there is not going to be any adaptation or any basic social net that will keep the most affected populations safe. So for me, it is actually a question, and that goes to Axel's point about why there is or how to deal with the increase in the unwillingness of populations to contribute, be it through taxation and so on. It's largely because of the unfairness. If you, and again, coming back to the financial crisis, if you see that there are billions and billions and billions thrown at bailing out basically Wall Street, while little people are taxed and things are getting harder and harder for them, then for me, one of the solutions to address that unwillingness to pay and to contribute is to bring transparency in the system, bring fairness into the system, and bring benefit sharing into the system. And that goes back what you said, making the hard choices, concessional finance. If you have limited amount of concessional finance, who gets it? Right now, I would say not those who deserve it get it. So there is a lot of money that goes in terms of concessional finance to leverage private sector finance, and in very many cases, it's not needed. Whereas you have a really, really, really hard time getting even continued support for concessionality for some of the poorest countries, for some of the poorest population groups. And one example that I thought is exactly what we shouldn't be doing is, for example, we had one project in the Green Climate Fund that was approved at the last board meeting. That was an adaptation project, actually cross-cutting, but with a significant adaptation component in the Niger Delta. So for some of the most highly indebted poor countries by the African Development Bank, and the Secretariat applauded the fact that those highly indebted poor countries are willing to take on loans to deal with adaptation as a sign of their commitment to deal with climate change. Those are definitely the wrong approaches. Again, if we are talking about the limits of limit availability of concessional finance, let's make sure that we give concessional finance and highly concessional finance, including grants to those that deserve it, bring more transparency, bring more fairness, bring more benefit and equity sharing into the system, and then I think we'll probably deal with some of the unwillingness to be a contributor to solving the crisis by individuals.
Okay, final word.
Okay, so that actually helps me answer Sean's criticism that we don't use our balance sheet to do more in leveraging. And that's a challenge that we face institutionally. Are you going to use highly concessional IDA finance to put into financial markets to leverage more finance? Or are you putting it into where commercial money is not prepared to go and where it is needed most? And it's a challenge, and our board faces that challenge all the time. It's a conversation, that's why we're using maximizing finance for development. Yes, it is about a leverage conversation, but we do need to protect large amounts of capital for those that really need it from the concessional side. Quickly to Paul's point, I mean, I think one, you mentioned President Kim there about inequality. I think, you know, one of the things, it's never easy to approach these things sometimes, but one of the things that we're working on now is the Human Development Index, which is about social capital. It is about rating countries about how they're investing in their populations and in effectively large amounts of social justice. And that's something that we're working on at the moment, and that will be coming out. I'm not saying that's the most popular thing that we're doing at the moment for certain countries, but it will come up with a rating system where, you know, ministers of finance and shareholders will be able to look at those sorts of issues. And I think that gets to the very heart of this equality issue that we're seeing. The next one of that, I'm suggesting on behalf of the president and the institution because he wouldn't be very happy, but equally that goes through natural capital accounting and natural capital indices. All the while we're not pricing these externalities, we're always going to have these problems. In the inability to actually do that, although we can do it, all the while you're not pricing in these externalities, you're not really putting capital where it needs to be and making rational economic decisions. I mean, that's as simple as it is. And so my final word on it is that, as a wise old lady once taught me, you know, we permanently search for silver bullets, and the reality is what we need is silver buckshot. And a lot of these conversations are really quite frustrating because it's an either or, it's this one's better than that one. And the reality is, if we're going to get to 1.5 degrees, it's going to take all the above. And this trade-offs about, you know, mine shinier than yours is just not getting us anywhere.
Thank you very much. And a big round of applause for the panel, please. So if you want to go get down, and I would like to invite to the podium